MoviePass turned movie tickets into a subscription, allowing users to watch films for a fixed monthly price. The model scaled rapidly as millions joined, attracted by unlimited access at a cost lower than a single ticket. At its peak, the service crossed millions of users within months, driving massive usage across theaters. But every ticket used increased cost beyond the revenue collected from each subscriber. The system depended on controlled usage, where most users would not fully utilize the offering. Instead, users increased frequency, turning the model into a loss on every transaction. Growth accelerated the imbalance as more users meant higher total losses. To sustain this, the system relied on continuous external capital rather than internal economics. At that point, the model was already under pressure even before it fully scaled.
As the service launched, MoviePass positioned itself as a subscription platform that allowed users to watch movies in theaters for a fixed monthly fee. Customers paid a low price, often under $10 per month, for access to one movie per day across participating cinemas. The company did not own theaters and instead purchased tickets at full retail price for each transaction. This meant revenue per user was capped, while cost increased with every ticket redeemed. For example, a user paying $10 could watch multiple movies worth far more than the subscription fee in a single month. The model depended on average usage remaining low enough to balance total cost across the user base. Early adoption suggested that many users would not fully utilize the unlimited offering. This created the assumption that losses on heavy users would be offset by light users. The system worked only if usage stayed controlled across the entire subscriber base. As growth accelerated in 2017, pricing was reduced to $9.95 per month, triggering a rapid surge in subscriber numbers. User adoption increased from tens of thousands to millions within a short period, driven by the low-cost unlimited access. This expansion was fueled by external capital, allowing the company to subsidize ticket costs at scale. The growth model prioritized user acquisition over profitability, with losses absorbed to maintain momentum. At its peak, MoviePass reported over 3 million subscribers, significantly increasing ticket volume across theaters. However, each additional user increased total cost exposure, especially among highly active subscribers. The system scaled rapidly, but each new user increased the structural imbalance between revenue and cost. As the subscriber base expanded, the model appeared stabilized because growth metrics improved and user numbers increased consistently. The company presented subscriber growth as the primary indicator of success, reinforcing confidence in the model. Revenue visibility increased through recurring subscriptions, creating the impression of predictable income. At the same time, usage patterns became more aggressive as users realized the value of frequent attendance. The system continued functioning because external funding covered the gap between subscription income and ticket costs. Operational adjustments attempted to limit extreme usage, including restrictions on certain screenings and times. However, these controls reduced customer satisfaction and introduced friction into the user experience. The core dependency remained unchanged, with profitability tied to behavior that could not be reliably controlled. The system appeared operational, but it depended entirely on continuous funding and constrained usage patterns. As usage data accumulated, the gap between subscription revenue and ticket costs became increasingly visible across the system. Heavy users attended multiple screenings per week, generating losses that exceeded their monthly payments by a wide margin. Average cost per subscriber continued rising, while revenue remained fixed at the subscription price. Reports indicated the company was losing tens of millions of dollars each month as usage scaled. Attempts to limit access, including blocking popular movies and restricting peak times, created user frustration. Churn increased as customers experienced inconsistent service and reduced value from the subscription. At the same time, investor confidence weakened as the sustainability of the model came under scrutiny. The assumption that user behavior could be controlled proved unreliable at scale. The fragility was no longer theoretical, it was measurable and accelerating. As funding conditions tightened in 2018, MoviePass could no longer rely on continuous capital to absorb growing losses. Cash reserves declined rapidly as daily ticket purchases exceeded incoming subscription revenue. At one point, the system ran out of funds, causing service outages when users were unable to access tickets. Emergency measures were introduced, including surge pricing, movie restrictions, and reduced plan benefits. These changes disrupted the core value proposition, leading to a sharp decline in user trust and satisfaction. Subscriber growth stalled as new signups slowed, and existing users began canceling subscriptions. The balance between acquisition and retention collapsed as both sides weakened simultaneously. Without sufficient funding or stable usage patterns, the system could not sustain operations. The model reached a point where both financial and user dynamics failed at the same time. As losses accelerated, MoviePass attempted multiple fixes, including pricing changes, tiered plans, and restrictions on usage frequency. These adjustments reduced usage temporarily, but also weakened the core appeal of unlimited access. Users responded by canceling subscriptions as the value proposition no longer matched initial expectations. Operational instability increased, with frequent app issues and inconsistent access to tickets. Management continued pursuing growth signals despite clear signs of structural failure. Capital raised through the parent company was consumed rapidly without achieving a sustainable balance. Attempts to renegotiate with theaters did not produce meaningful cost reductions at scale. The system remained dependent on a model that could not generate positive unit economics. At this stage, collapse was no longer a risk, it was a trajectory already in motion. As the system unraveled through 2019, MoviePass shut down its core subscription service after failing to secure additional funding. At its peak, the company had reached millions of subscribers, but the underlying model never achieved profitability. Total losses accumulated across operations, with significant capital consumed to sustain short-term growth. Subscribers lost access to the service, and trust in the model declined sharply across the market. The parent company, Helios and Matheson, faced severe financial consequences and eventual collapse. The idea of subscription-based movie access did not disappear, but it required fundamentally different economics to function. Later attempts to revive the brand operated at smaller scale with more controlled usage structures. The failure demonstrated that growth without viable unit economics cannot sustain at scale. The system did not fail due to lack of demand. It failed because the model could not support its own growth.